welcome for financial session for this. Thank you for attending. I think the whole idea which came, why to have a 10 crore of a portfolio? Why not 5 crore? Why not 10, 15 crore? Why minimum is 10 crore is required? I think the whole idea of this is understanding how last 15 to 20 years things have changed, if you look at from an Indian economy perspective, in terms of the expense what normally people used to incur. So that is something which make us to realize that why 10 crore become very critical for someone who is looking at to live a good life post retirement perspective, and secondly to make sure that all his goals are achieved. So we will take next part in terms of that. I think the first step we always say that most important thing for an individual is to understand his risk profile, and to understand the risk profile. Post that we have to look at what we have done as of now. So that's the reason we have created a tool called financial health check. So idea of this, which we Tara has shared in the group also, to make people understand that what are the basic things as an individual which we need to do before even looking at investments. Because most of the time what we have seen that we have not done our basics right, and that's the reason our investment journey not go smooth. To give an example, like yesterday I was having a meeting with a one client where he's having a car loan which where he's paying almost like a 11% rate of interest loan, and another side he's having a good amount of money which is sitting in a bank account. So idea is that first we have to understand, are we done or existing thing right or wrong. So normally as a first step always we tell three things which is basically which somebody needs to do it. First, to have a very good life cover. Good life cover means at least 10 times of income you should have a life cover. See, we normally do a personal human life value calculation other thing, but at least 10 times of income should be the base life cover. Second thing, we always advise all our clients that should have a good health cover. So at least 10 lakh of a basic cover with top up cover somebody should have. The reason why these things are required even before starting building 10 crore of a portfolio type of a thing, because otherwise if one way you are building a portfolio but another way there is a expense which come because of the health need, or you have to dip your portfolio. So indirectly it will stop your portfolio wealth creation process, because which is the most critical part. So first thing we have to do is that all sort of a roadblocks which stop you to build a portfolio, that we have to stop. So three things which we normally say which we have to look at: first, have a good life cover so that family wealth creation continue even you are not there and their needs are taken care. Second thing, to have a good health cover so that you don't need to touch your investments for your need. Third thing, have an emergency fund, because the moment you don't keep an emergency fund, so normally our view is that keep a 6 month of expense either in the liquid fund or FD, whichever is comfortable on an individual basis, they can look at, keep it separate so that tomorrow, whenever any need come, you don't take out money from any sort of a market instrument, because there are times when markets are not doing good. For example, like last 6 months, if you look at, markets have not given positive return. If that point of a time somebody taking out money from the equity, will not be a right way for a need. So always that keep as an emergency fund separately so that you don't need to touch your portfolio and your compounding thing continue. And the fourth and last, which is the most important part, I think we have to look at our expenses and we have to segregate which expense is possible to reduce or not to have. So, for example, any EMI which we are paying towards personal loan, or we are paying it towards car and other thing, we should look at how early we can close even for home loan also we suggest that let's make a plan that in next 10 years we should be able to close. So typically always that we should not hold it for very long period of a time, because our rate of interest should be lower than our ROI. And most of the time people do a mistake that they are doing investment in FD, which is giving 6-7% return, and they have a loan which is they are paying 9 to 10%. So these four things are very critical even to before start building a portfolio, because that's a core thing. And now I'll take that is 10 crore is just a dream or is it a realistic goal to achieve? Because someone may think that it's a very lofty number and something which is not possible to achieve. But data has proven that it is not something which is not possible to achieve, because it's a power of compounding. Secondly, the way growth opportunities are available in the Indian market. And third, most important thing, the way our needs have changed. So it is not that it's a dream, it is a need. And to make you more easier to explain, I think we'll have one question. So Tara, can we have a poll? Hello. Yeah, Tara, can we have a poll just to take it why 10 crore number is necessary? It's not just a dream.
Yes, sir.
Yeah, so we have just kept up one question that if someone age of 30, he wants to retire at 60 and his current expense is 75K, then how much corpus he will be requiring for the retirement? The whole idea of to keep this question is to make you realize that sometimes numbers looks bigger, but in real life it is not too big, because if you look at every 10 year your expense will get double because of the inflation. So somebody who is spending today 75,000 rupees a month, next 10 years his expense will be 1.5 lakh because of inflation. So what we have seen, if our investments are not giving higher than inflation post tax, because I think the tax component is the most critical part today's time, which many times we don't take into the consideration. That's the reason we say that whenever you are looking at investment, two things we have to look at: what is the ROI, and that should be not pre-tax and a post-tax basis, and it should be higher than the inflation. Yeah. Good thing I think majority of us understood that 10 crore is not a big number, and the whole idea of keeping 75K to show as expense, that to someone who has age of 30 who want to retire next 30 years, technically he need to build 10 crore of a portfolio. So that's the reason we kept this question, to make you realize that why you need 10 crore. So which is I think today 75,000 for someone who's at 30 is I think is a very normal number, which as individuals most of us are spending. And that's the reason we say why you need this corpus. I think the right answer is 10 crore. I think which we have seen most of us have taken. And the idea is to give the sense why we need this. The second part, which is becoming very critical, the way in last 20 years things have changed. One is that if you look at the longevity of the life, so earlier and today, last 20 years, if you look at the normal age, if you look at as a lifetime perspective, it has increased significantly. That means if you look at people are working for 25 years, but they need money for almost more than 25 years, almost double amount what they require. So the longevity of life, because of the improving health infrastructure and the quality of the life, that made more critical for individual to have a high corpus building. Second thing, now most of us have a nuclear family. It's not like a joint family system where we have a family support system who take care. So things are changing with the time. So that's also another reason why you need to build a corpus, because country like India, you don't have a governments are taking care, or uh, you can depend completely on the family. Third thing, the pension income. So the way government employees have a regular pension income, which is not there for the corporate employees as a whole. So that's also is another reason why you have to build. Even most of the time, people think that PF will take care of their retirement need. But if you look at over a period of a time, PF normally, even somebody who is doing a regular contribution also, PF only able to build one third of the corpus for the retirement. The balance two-third somebody needs to build his own. I think the fourth thing which becoming very critical from a today's time frame, I think the AI or technology is making most of the jobs irrelevant. So the only way for someone to survive is that if he has a built good financial corpus, he will be able to sustain. So I think next 1 or 2 years you will see that the whole job scenario is going to change, especially because of the automation and the way things are changing. So it the jobs are going to become more uncertain, and that is the reason where you need a financial security. So sometimes people may think that money will not able to take care everything, but it give a mental peace. So someone who have a good corpus build up, even something not going right with him in terms of financial side, still he can continue to live his life comfortably. The fifth part, which is becoming very critical nowadays, where kids have started staying abroad, and as someone get retired, so he may look at to settle down there. So that make a lot of difference in terms of the corpus requirement perspective. So if you look at someone who need today 1 lakh in India, technically he need, if he's living in abroad, he may need almost 2 to 2.5 lakh there. So the whole things will completely change in terms of the corpus requirement perspective, because when we are building a retirement corpus, most of the time we think that we continue to stay in India, but the way things are changing, where it's becoming a more on a global perspective, things are changing. People are staying abroad, and there are a lot of travel which is happening. So which means the need from a fund requirement perspective also changing significantly. And I think the another part which based on a study we have came to know that if somebody is building a retirement corpus or a wealth creation perspective corpus, so he has to start. See, you cannot build a corpus without doing a mistake. So many times we always say that you will only able to do right things when you have gone through right and wrong things, because then only you will be able to differentiate the whole thing. So we have seen people are investing, people are doing FNO trading, investing into cryptos through illegal platforms, or they are doing short term investments. But if they have done at their early stage, then it is okay, because the amount of loss will not be significantly high, and then they can able to go to the right path. So I think for the investing and building a corpus, more than a amount of money, I think it need as early as we can start. So if you are starting early, then even if you are doing a mistakes, those mistakes are not going to become very costly, because we will be able to know that these are not right thing. So anybody who is trying to do things where which is not right, investing into like doing FNO trading or doing something where going over allocation on real estate or something. So many times if you have done it at early stage mistakes, then you can at least rectify. So I think the more than the amount of investments, the early stage is more critical, because that helps to make sure that when we grown up, we will be able to do right things. So, what are the ways we can build up? I think the first and foremost way for most of our individual like us is that start SIP. So, normally people think that SIP will not just from a wealth creation perspective, it's about creating a discipline also. Because I think the in investing side, the most important part, if you look at, it's a discipline approach, because most of the times people are not able to save money because the moment money is sitting in a bank, something or other need come. So we normally say SIP is like a good EMI, where every month, because of the disciplined approach, amount get invested, and over a period of a time it get built up. The next step, which normally we say that do a step up SIP. So which means if somebody is doing today 1 lakh of SIP currently monthly, he should look at that every year he should be able to increase 10% the SIP amount. Why we need this? So that we can achieve our goals in much more quicker and faster way, because there are periods where we may not have a significant increase on our expense side and our goals may be far. So what we have seen that in a whole life journey, there will be a 10 years of a period, which we say it's a golden period of investing, where your goals are not nearby and your savings rate will be higher. Those are the periods where we should go and do very aggressive investing. We should not go with the regular way of investing where we just decide a small amount and we do the investment. So if you look at the example, if somebody is doing a 1 lakh a month investment with 12% of a return, he can able to achieve 10 crore of a portfolio in 20 years. The point is, if somebody want, okay, I want to achieve the same thing in a shorter duration, he can change the amount. So point is it a big deal today? So I'm saying today 1 lakh a month investing, I think it is pretty much possible. But thing is, it need a time. So I think the most important part, if you look at, I think the time period which is need, and as you increase the overall investment amount, it will take care of your corpus building. But one thing we have to understand that for the whole investment cycle, which what we have seen with our thing, you need 12 year of a time. So even somebody may increase instead of 1 lakh, 2 lakh of a SIP, he will not achieve the goal in 10 years. So that's the one thing which we have to understand that to build a corpus, you need a time. You can't do it in a short period of a time. You need a 10 to 12 year of a good time. So many times people think that once I start earning more, then I'll invest more or I'll do start investing. But that real life doesn't help, because most of the investment need time. The second thing is that the portfolio diversification, because that helps to take care of the market fluctuation. So typically, equity should be the larger allocation at a younger age. As age increase, it can reduce the corpus. Then a debt part and alternatives. And today, hybrid also could be a good way where you can have a combination of equity, debt, and alternatives as the approach from investing perspective. Third step is lump sum investment. So whenever you have in between any sort of a good corpus, you should start doing it. And the ideal way, which we normally suggest, that instead of doing as a one-time investment, do it in a STP way, so that even if market fluctuate, you don't get a hit because of doing investment at a wrong time. So many times, how we do the investment, it make a lot of difference. And the fourth thing is that keep the return expectation very clear. I think most of the time people do a mistakes or buy wrong products because their expectations are wrong. So in our view, I think as an investor, we should keep it 12% post tax as an expectation, not even 15%. The reason is whatever additional return what we get, that is our bonus. But when we are doing a planning, we should keep our expectation normal, because there are a lot of things which we don't know what is going to happen in the future. So many years you may see markets have not been rewarding in terms of good returns. So if our return expectation are right, then automatically we will be able to go in a right way. We will not try to build a things in a short period of a time, and we don't end up buying a wrong product. Because we have seen like people end up buying mid and small cap fund thinking that okay, I need minimum 30% return, and instead of getting 30% return, they actually lose out the capital itself. Because even if you are investing, you have to look at the valuations also, and not all the fund will do good all the time. So there are cycles where if you have entered at a wrong cycle, you end up losing the money instead of making it, and the whole wealth creation process will take time. So in our view, I think 12% post-tax is a good number to look at. And whatever additionally we get, that's something which we have to take as a part of the future thing. The fifth thing, financial discipline. I think we have to plan and do it on a disciplined way. And I think one of the thing what we have realized over a period of a time in the investment journey, I think one of the most important thing, you should have one sarthi. So normally we say that it's easy to start, but once your portfolio size started becoming bigger, one thing what we have seen that people have started taking out the money, and that's where they are not able to build and take to the next level. So that's a role of why you need a mentor, advisor, or sathi in your life. Not to, they will not help you to increase your portfolio return, but they will make sure that you will achieve your goals. I think in today's time, I think most of the people are doing a mistake that they are just thinking that advisor's role is more to increase the return or take care of the diversification. I think their main role is help you to achieve your goal. So if your goal is to achieve 10 crore, I think the most important part, they will able to guide you that why you have to continue holding the investment and review it and do the changes, but don't take out, because I think that's the most important thing. And that I'll show you with the number that why it become very critical as a whole. So just to give an example, how it is going to make a difference as a whole. So we have done one study and we came out that initial 2 crore of a portfolio building, that is something which is very critical, which need a lot of support from the investor side, where you have to have your allocation and investments on the higher side. But once you build 2 crore of a portfolio, after that actually the power of compounding will take care of your investment. So if you look at somebody have a 1 crore of a portfolio, to reach 1 to 2 crore of a portfolio, it needs 6 years of a time if somebody is getting 12% return. But once he reach 2 crore of a portfolio, if you look at all incremental 1 crore, so to reach 2 to 3 crore, it need 3.5 years. Then if you look at 3 to 4 crore, it need only 2.5 years. Then 4 to 5 years, it need 2 years. And the same way, if you look at uh, the time period what we need for additional 1 crore, it will come down. So somebody who built a 9 crore of a portfolio, 9 to 10 crore, it just need a 1 year. So I think the most important part, if you look at somebody who is looking at to build 10 crore of a portfolio, first thing he has to look at, he should make sure that he reached the portfolio of the 2 crore. The moment he reached 2 crore of a portfolio, then even he is not doing additional investment through SIP also, still he'll be able to reach his milestone in next 10 to 12 years. So if you look at the essence of the building a 10 crore of a portfolio creation, is that you have to do first step of building a 2 crore of a portfolio. So your goal should be divided into a multi-layer. So first goal should be how I able to reach 1 crore, and 1 to 2 crore technically it takes 6 years if you're not doing any additional investment. To do additional investment and reach this goal in next 3 to 4 years. Once you reach 2 crore, then next 10 years you will reach 10 crore of a number. I think that's the most important part if we look at. And now I'll take some examples and make you explain that how we can able to reach these numbers. So somebody who wants to achieve in 22 years need 55K, but in 10 years you need a very high number. So people who think that okay, I can achieve goals in a short period, that is not possible. I'm saying you need more time than the money as a part of investing. So that's the reason, as early as you start, you going to do well. So you can just see the difference. 55K for to achieve goal in 20 years, but if you need in 10 years, you need 4.3 lakh. I think that is the power of compounding, which somebody needs to understand that amount of money is not going to make the change. The second thing, asset allocation. how we do a combination approach that going to make a difference, so which includes have a good fair mix of mutual fund, index fund, stocks. On a debt side, have a PPF, EPF, debt mutual fund, bonds. Gold could be 5 to 10% of the portfolio allocation. Real estate side, or always view that look at only from on stay purpose, except if you want to buy real estate further, buy as a land. Don't buy flats for a rental income purpose, because if you look at rental yield, it's not going to help you. And FD also, you should only do it as a part of emergency fund, because post tax, if you look at FD returns, doesn't make sense. It's below inflation. So what are the investment options? So large cap side, we've given some example to give you that today you don't need much. So there are a lot of things you can do: large cap, flexi, mid cap funds, stocks, and other thing. Typically, we suggest to avoid doing a stock investments, because what we have seen that if you are not using the fund managers, most of the time people end up holding the stocks which are down, and they continue to sell which are doing well, and they end up having a portfolio which have mediocre or a negative return, because most of the times index returns will be higher than the individual stocks return. That's the reason you either use the fund managers or avoid doing direct stock investing. PPF NPS could be a good long-term tax-efficient investment option from a debt exposure perspective. SGP today, sovereign gold bond, it is not there, but you can buy through exchange if you want to build a gold exposure, because you have an additional 2.5% return. And plan investment to minimize the tax and maximize the post-tax return. I think that's the most important part. And regular reviewing, increasing the SIP, and continue to hold the investments, because even time like today, where we have heard that okay, in US is increasing tariff across, but we don't realize that there are other positive thing is happening. If you look at the crude oil price, from 80 to 90, now crude oil has reached to $60. So from India perspective, if you look at lower crude price can work very well. Second thing, if US is increasing tariff across, so there are opportunities which are going to build for country like India, where we may get more export opportunity instead of what other countries were getting like China. So because compared to China, we have a lower tariff rate. So I think we should not waste our time and stop doing investment thinking that because of these tariff or a global war and anything. Our role as an investor should be doing an investment, and the fund manager will take care where to put money which will not have higher impact because of those things. Because anyway, one thing which is very clear, either you get a good price or you get good news. You will not get both. So today we are getting a good price where markets are down, and for someone who's starting their investment now, for them it add a lot of value, because you will be able to do investments and corpus building. And second thing, we always look at one side that okay, these are the negative things happen, but one thing we have to understand that the worst of the time, COVID is the best example, where we have seen that markets have corrected 30% in a month, but you look at how markets have recovered post that, even when companies were not working. The reason is government has done a lot of liquidity in the market. So one thing we have to understand that market continue to do well. It's only thing it will show you short-term volatility. People are able to hold the short-term volatility. They are the one who will be able to do well. And second thing, many a times you may able to exit at a right time, but you will not be able to re-enter. There are very rare investors who are able to do entry exit both right. So you may exit post that markets come down, but you will not be able to re-enter. I think that's where you lose out the power of compounding as a whole. And I think that 10% annually. So if you look at the best example for someone who's starting his career and want to build even a monthly SIP of 55,000, can able to build with the 70-30 ratio, have a good corpus on equity mutual funds, debt, gold, and do a step up every 10 years, that itself can build 10 crore of a corpus building. And the final thought, if you ask me, I think start early and stay invested. That's the most critical part. Then amount, Second thing, choose tax efficient investment option, review and adjust yearly. Wealth is, I think it's all about time, discipline, and strategy. And if you ask me, the one thing as an investor, what you should do, you should focus that how you can reach 2 crore of a number. That should be your primary goal. If you want to achieve 10 crore of corpus building, you just focus that how I can able to achieve 2 crore of a number. If you reach 2 crore of a number, then in next 12 years, automatically you will be able to build 10 crore of a portfolio, even if you don't do any further investment. So I think that's the most important part, that we have to create a many milestone, and then we see that how we are able to take the investments journey to the next level. I think that's the essence of this thing, that we should know the goal and we should know what we have to do. So initial 2 crore, your role is important. After 2 crore, the power of compounding will take care. Yeah, so I think that's all from my side.